Welcome to the Broken Pie Chart Podcast, episode 363. I'm your host, Derek Moore. Back again with me, Mike Snyder. You were off last week, Mike, right?
I was off last week.
All right, we'll get to that in a second. And then Shane Skinner back again. All right, I want to start off. I think we have to touch on Bitcoin and strategy. MicroStrategy, I still call it, but it's strategy. I mean, today it goes up 26%. Yesterday, it was down quite a bit. Bitcoin at one point, I think, was below 65,000. It's since come back up. And they had their earnings call yesterday. So, I mean, when I look at the earnings the earnings to me on strategy are a little bit irrelevant because they basically own Bitcoin. And I mean, yeah, they own Bitcoin. And if you're buying MicroStrategy, you're saying you believe that Bitcoin's going to go up from here. That's one thing. The second thing is that you're okay with paying them to operate a strategy for you. And you're okay with them issuing debt or diluting the shares by issuing more equity to do that. And, you know, I mean, their expenses, they're running a company. So their expenses, if you look at their SSGA line and their balance on their income statement, it's, they have expenses. They have marketing, general selling expenses, general other stuff. So, like, is strategy a good idea to buy or not? I mean, I don't know. I mean, if you think Bitcoin's going to go up, that's first and foremost your baseline. If you don't think Bitcoin's going to go up from here, you probably are going to look elsewhere as far as an investment. I'll let everyone decide that, whether they think it's going to go up or down. And then you look at the debt. So their market cap right now is 44.855 billion, I believe. Yes. And their Bitcoin reserve, I don't know if this is even updated yet. And then their debt. So their debt stack, if you kind of look at the credit, it's like 16.6 billion between the converts, convertible bonds, and the preferred stock. So, like, anyone who thought this should be up when Bitcoin was going down, it's just not the case. I don't know. I mean, Mike, I'll start with you. I'm sure you listened to all 3 hours of Michael Saylor's or the team from Strategy's call yesterday, the earnings call. I'm sure you were on there for 3 hours taking notes, right?
I was not on for 3 hours, but yeah, I mean, it's a Bitcoin play. So if you take Bitcoin away from this equation and sort of, obviously you only own this if you think Bitcoin's going up.
Yeah.
But if you take away your opinion of Bitcoin and just kind of look at what this is there a case to be made that it's worth paying a premium because of how much of the asset that they own, and that it would be, I don't want to say impossible, but very difficult for any other entity to come in and control this much of one asset without really driving the price higher?
I mean, Mike, you're I guess for a retail investor though, would you say that if you want Bitcoin, you either buy Bitcoin, you buy something like IBIT, which is an ETF that tracks Bitcoin, or you buy MicroStrategies? I mean, those are the three choices. So, Mike, like, why are people gravitating to this? Do they think the leverage is going to gain more if Bitcoin goes up?
I mean, I think that has to be one of the reasons. I can't really personally think of a great reason to buy it when you could just buy Bitcoin, but it has to be belief in obviously the leadership there and how they can maneuver and, buy Bitcoin, and also the fact that they own so much Bitcoin and it potentially being a leveraged version of it.
We talked about the debt, and if I look at the debt stack, 8.3 billion in total preferreds, 8.2 billion in total debt. And the way you do it is you take the market cap of the company, which is the number of shares times the price, which is about 44.8 billion. And then you add the debt to it, you get what's called the enterprise value. So it's the equity plus any of the debt. Because if an enterprise value, if you, let's say you were going to buy Strategy, you're going to just raise some money, you're going to go out and buy the company. You have to buy the debt too. And you've got 50.2 billion of Bitcoin on the balance sheet. So Mike, if you're going to buy the company, you're basically buying all the debt, buying all the equity, and there's no premium. Mention there's no premium to buy it. It's 59.2 billion. You get 50.2 billion in Bitcoin. So you'd be paying more than the value of Bitcoin, right?
Yeah, when you buy shares of the stock, if you think it's just a pure Bitcoin play, I mean, it is based on Bitcoin, but you're paying a premium because there's operating costs and debt, like you said.
I mean, Shane, we talked a couple of weeks ago. Running a company isn't free, and there's also, I don't know, I haven't taken that much of a look at it, but there are stock-based compensation, there is salaries, there's legal costs, there's all sorts of costs here. So, I mean, Shane, I guess like we're not trying to make an opinion on Bitcoin. It's interesting. And Mike made the mention too. And I think you and I talked one of the weeks. What if they were just buying Apple instead of Bitcoin? Just you're issuing debt to buy Apple shares. And that's the only thing that you did as a company. Like right. I think sometimes the Bitcoin clouds people's thinking on what this is or isn't, right?
Yeah, no, I mean, I think that it's when access to Bitcoin wasn't nearly as easy as it is today. I think there was a argument for it. It was easier to access, right, on the secondary market than going and opening a crypto wallet or going to, one of these newer exchanges. Some people that's not for them. So prior to that, maybe there's an argument for it. We haven't really gotten into it before, but if you just go to Strategy's website, you can see all of the different, they have a long duration high yield credit product. They have a structured Bitcoin product, long duration euro denominated credit, short duration high yield credit. So it seems like they're just cutting this thing up into all these different ways to either achieve yield or, like we've said, own a leveraged version of Bitcoin. But that's achievable by the average investor by just simply going and buying the same products you've mentioned. So yeah.
You had asked me if I was going to listen to the call, or not listen to it, if I was actually on the call, what would I ask? And I would ask,
question.
What and an analyst did ask it. So one of the analysts, I forget the gentleman's name, he asked, could one of the uses of US dollar reserves, meaning cash that they have on the balance sheet, be to pay for if the bond is put? And I'll just explain it. There's a 2028 convert. It was issued in September of 2024. The maturity is September of 2028. There is a put date of 9/15/2027, and then the earliest it can be called by the company is 12/20/27. All from Strategy's website. This isn't anything that you can't just look on your own. The conversion price and the way a convertible bond works is you can convert into a number of shares, and it just depends on what the terms are, at a certain price. So the conversion price is 183.19. I mean, it closed today. Who knows what it's going to be in, it's 134 and 0.93, I think was the close today from what I can see, just kind of staring at my screen. But let's say the price is below the conversion price. The investors, in theory, have this put option where they can say, I'm going to put the bond back to the company and give me my money back. And anybody can research. There's, you look at the covenants on those. But yeah, Shane, he did ask. And so, you brought up, if we have no idea what Bitcoin's going to do, we don't necessarily know what the strategy is going to do. It can trade at a premium, at a discount to its Bitcoin holdings. But yeah, I mean, like at some point, if that gets put to them, and I think it's a little bit over $1 billion. Saylor said, yeah, we could use our US dollar reserves. I guess they could issue new shares.
That's what I said. Yeah, issue more equity.
And I think they're up to, I could tell you the number of shares, but they've definitely issued a lot of equity. So I guess, to be clear, I'm not saying that people should buy this or shouldn't buy this, but it's what you should be thinking about. You should be thinking about, take away Bitcoin. I've got some debt out there. I owe dividends on the preferreds. I owe interest on some of the, some of these have coupons, although coupons are small. And then there are some put options for where I might have to buy back the debt. Basically.
Yeah, you're adding corporate and operating and lending expenses on top of your Bitcoin exposure. Like you're essentially exposing yourself to Bitcoin plus all of what we've just described in terms of expenses and risks. So it's like, I wonder if there's a way to quantify like what the expense ratio on the exposure is versus sort of like what you're getting.
Yeah, somebody should do that. It's not going to be me.
No, me either. But if someone's listening and cares to take that up, please.
So if you look at, I reference IBIT a lot just because it's the iShares Bitcoin ETF, and it's a pretty big one. And I'm curious what their expense ratio is on it. Like Mike, that is an interesting question. Like, what's the operating expense or the annualized expense on them doing it? And I get it. Part of their pitch is we're creating leverage and all this other stuff. But you can buy IBIT at 25 basis points a year. I don't know. Mike, what are you doing tonight? You want to go through their balance sheet and calculate an expense ratio? I don't know. No, don't do that.
I mean, it's sort of like if you buy an actively managed mutual fund, you're going to pay more than if you buy the index because you have someone in there that is supposed to be able to, or their goal is to outperform the market, right? Or their index. So I kind of view MSTR similarly, where you're paying a premium because you think someone can, the operator is able to accumulate Bitcoin, in ways better than you can.
All right. I think we got to our maximum Bitcoin that we can talk about. So I'll move on from there. So it's back over 70,000. I think it was below 65,000. I kind of wonder at what point, though, I guess I'm not done talking about it. At what point do people who own this, who were late to the game, doing it through ETFs, at what point do they say, oh, wait a second, this volatility is not for me. It's easy to sell. I can get rid of it. And who's to say something else doesn't come around? But all right, now I'm really done talking about that. Let's talk about volatility this week in general. I mean, the market screamed up higher today. We had a couple days where it looked like, some people were saying, is this the turn? Is this really going to go? Shane, I mean, looking at volatility, it was surprising to me, given how close we are to an all-time high. I mean, we were just at 7,000. We just touched it intraday. We haven't closed there, but we just touched it. I mean, a VIX at 20, what was it, 22?
Yeah.
I know it went a little above there.
I think 22 and a half maybe.
But it seemed like an awful lot of angst given how close we are to the all-time high.
Absolutely. I also think that, I've seen throughout different things on X and just different channels, people talking about how much call writing in the shorter term has been going on at like that 7,000 level on the S&P. And so, if that's true, if there's like a lot of calls being written there, it creates sort of this wall that's really hard to break through. And this isn't the first time you've seen this in markets. This happens all the time. Both on an intraday basis, I think, and longer term. But, everybody's selling calls at 7,000. Market makers are long them. We've talked about the flows and how that works. Market makers are buying calls at 7,000. That's a level where they're often going to have to sell off of, right? Sell stock to hedge the exposure, their deltas. And so it's one of those where it seems like we've just tried, we couldn't. We pulled back pretty hard. And yet today we're almost, did we close up on the week?
On VIX? Or on market? I don't know that yet. VIX, we ended in the 17s.
Yeah, we closed up on the week. We closed higher. In all of that all week. I mean, Mike and I talked all week about just, this is different. We were starting to wonder, hey, what's going on? And it's, the rally today was pretty impressive, to say the least. We'll see how we follow through next week. But
to give you an idea, so the high was 23, the high price. I just did a chart of the high price instead of just
on
last
VIX
price of VIX. Yeah, so intraday got to 23. Mike, we've obviously, I kind of wonder too, gold was up about 13 points today, close, GLD, sorry, not gold. GLD as a proxy, 455.46. But the volatility on GLD at one point was 55%. So I'm using the 10-day call implied volatility, just kind of a shorter term one that really encapsulates the spike. It got up to 55. It ended around 38. To give you some perspective, early January, let's say, first part of January, it was, I don't know, maybe mid-20s. It was under 25, though. In December, the most it got to 25. But it spent time in December, all the way down at 17. For those of you playing the home game, it's when you have an implied volatility, take that number divided by 15.875, and that's the expected one standard deviation, plus or minus move in the underlying. So I just wonder, like, gold had its sort of blow off top. Is that the blow off top? Is it going to be a while till we get there? Some people argue it's on the move anyway. But volatility is coming down, but it's still high. Like, is gold going to settle back into this more of a reasonable range, not like going up 25% in a day or down 25%?
Well, I think, yeah, I don't expect it to continue to trade like that. It could. In 3 days, it dropped like almost 17% from its high and then rallied back a little bit. I remember I was looking at gold options, GLD options versus options of other companies that had earnings coming up, like Apple. I don't remember exactly what it was, but the volatility in them, or the expected move over the same time period, was like double in gold versus a stock like Apple that was just about to report earnings. So it's the volatility has been pretty historic and warranted when you look at the move that it's made both up and down since really mid-January.
Is this right? Off its high? Let me just expand this. Yeah, so it closed today down 8.15% off its high. And, a 10% move from here would be 45 points.
Right.
45 points on here would be back to 500, correct? Yeah, right about 500. So, gold historically it's been one of those things where it makes these moves, kind of settles in. If you look in the 80s or really the 80s and 90s, it didn't really go anywhere. But even today, I remember when you mentioned that, Mike, though, comparing some of the IVs or the options, we run some strategies for some people that are selling covered calls on something like GLD, different strategy than, just wanting all the upside in gold. I remember at one point we had one, Shane, you remember this. I said that normally we'd have to roll that because if the person doesn't want to get called away. And we said, no, there's like $10 in time premium left when ordinarily there would be 90 cents, right? So
right. Yeah. Everything gets inflated. It seems like the market sort of starts pricing, like the market's always pricing in a range in options, right? For each given maturity date, you could call it the term structure, the sort of, term structure. But more importantly, what happens when major moves like this happen, even to the upside sometimes, that's outside of the expected range originally. Most people associate expanding volatility, right, with down moves. Major down moves usually are incorporated with volatility spiking, right? VIX usually goes up when the index goes down. But when we see something like gold do what it's done, sort of go parabolic straight up, and start trading outside of its average or expected move as frequently as it did, everything sort of gets juiced in extrinsic value. And so, because how can you tell, like, good luck guessing where gold's going to be on a normal week in this market right now? Good luck guessing where gold's going to be next week. Nobody has any idea.
So I'm just looking at non-farm payrolls, and very quietly, I mean, it added, looks like non-farm payrolls added 50,000 jobs, so not a negative. It was a little bit lower than November, higher than October. Okay, this was December then. Yeah. So did we just get the December number? I guess we did, didn't we? I thought we had another number here. Yeah, so just December. I don't know, that came and went with little fanfare. I got to be honest, I wasn't watching CNBC. I really don't watch CNBC too much during the day anyway, but I feel like that went under the radar today. I guess unemployment rate, Mike, is next week, next Friday. So that's the one to really keep an eye out for.
Yeah, so I mean, just in terms of what gold did over the past week, I mean, do you think that it's to do with monetary policy and the Fed and sort of more confidence there? Does that play a part in it? Is it profit taking? Is it, stronger dollars? A combination of these? Like, can you point to one thing you think you can say, like, oh, this makes sense. This is why gold dropped the way it did?
I mean, it's with any parabolic move, at some point it's going to happen. It doesn't matter whether it's rough rice, actually, I don't want to say the tulip bubble, but that's a bad example. But with any of these that sort of go up exponentially for a bit, at some point it's got to take a breather, got to come back down. I think it was a lot of the people who never would have bought gold before started hearing about it on the news, all of a sudden started buying it, and they're late. And it's typical behavior from investment crowds. And yeah, I mean, I would say that it just, the marginal buyer sort of came out of it. And whether that shakes out the weak hands, you could make an argument it shakes out the weak hands. They kind of go away and they say, well, maybe this isn't for me. And then the real people come back in. It was central banks, though. And Kevin Warsh, his prior statements seem to indicate he's a hawk. And which is curious because from all accounts, Trump wants a very easy Fed where they are lowering rates. So I guess we really won't know until we know, but he has advocated for shrinking the balance sheet. So, like, Shane, I don't know. Well, actually, Mike, it was your question. I mean, what do you think? I mean, I think it was Warsh.
I think that was sort of the catalyst that initially drove it down. And then, going back to something you said about Bitcoin, actually, I think there were buyers that came in expecting gold to be something different and, maybe bought it recently and then just felt like I wasn't expecting this type of volatility. I think some of the late buyers maybe that came in started hearing about it, especially from, silver too. I think, the move in silver brought a lot of attention to metals in general, and just sort of, investors came in late and then took their losses early and said, I don't really want to be watching this.
It's interesting because when you run, and look, we run strategies that have gold in it. Sometimes we use options, sometimes we use an ETF. And we actually, when I talk to investors or I talk to institutions or advisors about one of our strategies, one of the things I tell them is, and they always ask me for a back test, and I say, look, it's going to look really good if it has gold in it. But if I take different periods, maybe it doesn't look as good, maybe. But gold historically has been a diversifying agent. It's got historical non-correlation to equities, non-correlation to bonds. And so bonds, stocks, and equities together in a portfolio have some interesting anti-correlation and diversification prospects to them. But it's one of those things where sometimes I think people do a test, they run a test, and there's some recency bias where, I mean, look, last couple of years, gold has been unbelievable. And so they add it, but they add it late. And gold is one of those things, like you have to have it. If you want to get the diversification principles, properties, you have to have it in there. And you have to have it in there for a while. And I'm not going to say it's trend following, but trend following, it works. It has these really good periods, and sometimes it doesn't work and it trails and people get tired of it and they get rid of it. But yeah, I don't know. All right. I mean, Shane, I'm going to go back to something I asked you. Sometimes I look at high yield and I say, well, high yield's not selling off and the market's selling off. Like, who's wrong? Other times it's flipped. We did this thing with Apple. Who's wrong? Like, why is the market off 1% plus and Apple is flat for the day? And quite honestly, if Apple had been down, given the size of Apple, the index would have been down much more. We said that, you and I kind of going back and forth. If it's not you and I, just take credit for it. It's good enough, you know? Like, who's wrong? Apple was right, apparently.
I'll take any credit I can get. But seriously, it's interesting. We talked about it many a time. I think Apple's more defensive in terms of a mag name, right? Although all the mag names sort of, I shouldn't say all, but quite a few of them ran today after being beaten down pretty bad. You know, I'm going to see your Apple and raise you Microsoft and tie them all together here. And we talked about earlier in this week, you know, the move in Microsoft's really considerable. Looking at 555, I think was all-time high. And we bottomed this week at, where was the low? 392. So, you know, you're talking about 163 points off of 555. That's 25% roughly, right? A little more than that.
Microsoft is in a bear market.
Yeah, it's in yep. And so you mentioned it earlier this week. You know, you said it's the open AI thing, possibly, right? Are they being punished for this investment, this CapEx, all this cash they've thrown at AI development, and it's not necessarily paying off? Who knows, right? Could be a multitude of things, but it's sort of interesting.
Hey, Shane, I'm glad you bring up this point.
Apple's been patient, right?
Apple, well, yeah, I mean, and Apple historically, I mean, they're not the first on a lot of this stuff. Sometimes they were first, but I have to research and see what the scope and the size of Microsoft's OpenAI investment. But part of the thesis, I guess, of Microsoft when it ran up, according to some analysts or some people, is they've got an embedded call option in OpenAI because they have that investment. And so if OpenAI were to IPO at $1 trillion valuation, I don't know what Microsoft's valuation is that they got in, but there's some relationship there. And here's the problem, Shane. Like, we can't see what OpenAI's balance sheet looks like, its income. The reports are that they haven't made money despite being valued at a very high rate. So I don't know. I mean, is OpenAI, is it Netscape? Well, you don't remember Netscape, but is it, one of the browsers you don't even know anymore? Or is it Google? And yeah, I don't disagree. They drew down at the lows the other day. They were off 27.38%, Shane. At the same time, the market was making an all-time high.
So let me ask you this: do you think that the Musk lawsuit towards OpenAI and Microsoft has anything to do with this? Do you think this is the market almost preemptively sort of pricing maybe that not going in OpenAI and or Microsoft's favor? For those that don't know, he's essentially claiming that OpenAI broke its original mission and unfairly benefited from his contributions to the company or the firm or non-for-profit, if you will, as a co-founder and donor originally. So I don't know. Maybe
yeah, I mean, I think we saw, you and I commented on a news story where I believe the judge okayed it going to the discovery phase. And I besides watching Law and Order, I have no legal training. But if you break into anybody's house at any hour of any day and turn on a TV, chances are if you flip enough channels, you'll find Law and Order. But yeah. No, I mean, that will be really interesting. Like if it actually gets the deposition and some of the stuff, because Elon Musk can be deposed and Sam Altman can be deposed. So maybe that sheds to light some of the financials there, or yeah, I don't know. I guess the danger is the judge says, well, you can't do what you did, or you can't do more. And Microsoft had being an investment in a quasi, it was not for profit, now it's for profit. Yeah, I don't know. That would be interesting. Mike, what do you?
Go ahead.
Go ahead, Shane.
I was just going to say, does Microsoft sort of eat what it's put into them, and then from there, that's it? Does it affect them further? Like, obviously, we'll see. But the biggest thing is, does this almost reinforce OpenAI wanting to go public and shift because something like this is on the table potentially? I don't know.
I will tell you, I mean, Microsoft reimagined themselves, I guess. 2017, I think it took them till 2016, 2017 to exceed the late 99, early 2000 high. 17 years. And since then it's been, and they've turned themselves into a cash flow sort of machine where they're getting that reoccurring revenue. All their products are subscriptions now. They've gotten into the cloud storage. Like, I can't tell you where the stock's going to be tomorrow, 3 months, 6 months, but certainly they've reinvented themselves. So I don't know, Mike, it's one of those weird things where you have the market at all-time highs, but there's so much dispersion in the returns of these companies, these big companies.
Yeah, I mean, so the market sells off, and it sort of seems like it's AI bubble talk again, and companies with large capex are getting hit. And Google had their earnings; all of the numbers looked, it looked like they had a great quarter. Their capex number was huge, and so there's concerns again. Are we in a bubble? What are the actual returns going to be on this capex? And so, I mean, what tech company do you probably want to own if there's AI bubble concerns and all this capex concern? It's probably Apple. Their capex is a fraction of what these other large tech companies are spending. And so they have a lot of cash. They are sort of, and Shane has mentioned this a few times, they're sort of like the safer version of one of these big tech companies. And so I think it kind of makes sense why it didn't go down when the rest of the market was. And, they just don't really have that same type of exposure right now to AI as some of, the amount of money some of these other companies are spending.
Yeah, I mean, you're saying all else equal, there could be any other factors that make it go up or down.
Sure.
Be good or bad. But yeah, like if you're just looking on a CapEx basis, it also is, Mike, like is value having its day. Look at something like DEEP, which is a small and micro deep value ETF. Not a recommendation, but I mean, that's near all-time highs. deep value. I mean, small and micro value. Like, who knew, right?
Yeah, when the market was selling off, I was looking at individual stocks, and there was, plenty of stocks that were hanging in there. Energy stocks were doing well. Stocks like Procter and Gamble were doing well. So
Costco,
Walmart is still on a tear, hitting an all-time high today.
Pepsi up 18%.
Pepsi, yeah. So there's still companies that are thriving amid the CapEx concerns and AI bubble concerns. Markets continuing to broaden out, and you're seeing leadership from other areas, continued leadership from other areas.
It's just not the Mag 7 anymore. It's not. It's
really not. It creates short-term volatility when they report earnings, and it's sort of, a lot of selling of a lot of companies, but that's not all there is. There are other areas performing very well.
Do we get a non-tech company in the top 5 in the S&P from a market weighted perspective? Like, does that happen at some point? And, I'm just looking, throw Berkshire out of the way. If I look at the top index holdings in something like SPY, which is the State Street S&P 500 ETF, they're all right now. Apple, Nvidia, Microsoft, Amazon, no surprise, Alphabet, Broadcom, Meta, Tesla.
Can Walmart do it?
That was the funny part. Remember, we were kind of joking. Would you rather own Walmart at a 40 forward PE, or would you rather own Nvidia? And I think since last week, Walmart's done better. That's why you buy the index and you hedge. But it's like, so I'm looking at the company, Shane, and I'm looking at the net. So JP Morgan, Eli Lilly, and Exxon are sort of the next 3 extension behind that. Again, throwing Berkshire. Johnson & Johnson.
No kidding.
Walmart's next. Visa, MasterCard, Costco. Like, there are these companies that are down there. Now, if I look at, what was the last one? So Tesla represents about 1.92% weight. JP Morgan's about 1.45. That doesn't seem like a lot on a percent to percent, but there's some companies who have some work to do. Or does some of the other ones fall back? Microsoft is number 3. At one point, I think they were number 2. And Nvidia and Apple, it's getting close again between those two, because Apple has gone up. Well, Nvidia hasn't been, it's been more sideways. So that's a little bit of a race to watch. But yeah, like below the surface, there's a lot of companies that are doing interesting stuff. And from a movement standpoint, it's not just the Max 7.
Derek,
yeah. How about Walmart? If you compare it to Nvidia, compare it to Amazon. Walmart at a 40 PE versus Amazon at a 27 PE. It's surprising.
Well, and Amazon has the data centers. They're selling cloud computing as well, right? So.
Yeah, no, if do you think that's a mentality thing? Like, people think of Walmart as defensive in a way. So almost you just see naturally money flowing into it, whether it's trading at a higher multiple than it should be or not.
Walmart is 45.84 next time's earnings, next 12 months earnings. Amazon, now I'm curious, Mike, I got to look this up. So Amazon forward PE on next 4 quarters, 27. Look, I'm not a stock analyst. That's why, people sometimes say, well, what do you mean you don't know how to evaluate companies like this? Yeah, I'm evaluating companies, but I'm not doing channel checks. I'm not doing what the analysts are doing. I'm not calling people up. I'm not going to the stores. I'm not checking with other suppliers and buyers and all these types of things. But on the surface, they both ship stuff to people. They both have, Walmart has stores, which you think has higher overhead. Amazon has data. Amazon's figured out the last mile of delivery, where maybe Walmart hasn't. So I don't know.
Derek, do you think that it has something to do too with, something I think you wrote about this in your book, but the money's not flowing into bonds. At times, it seems like when things get a little questionable or there's a little bit of volatility or uncertainty, when you would have historically seen money flow into bonds. Obviously, gold and metals have done what they've done recently, but and maybe that's coming. Maybe TLT breaks out eventually, but it seems like, would you say money's being just taken out of one area of the equity market, it seems like, and just put back in another? It's not necessarily, seems like it's leaving.
I don't know. I mean, like if I look at AGG, and one of the things you can look at is the current share count, because when people buy an ETF or sell ETFs, they do what's called creates and redeems. So if people are buying the fund and putting more into it, they create more shares. If people are on net, and that's on net too, but on net selling it. And I look at AGG, and I think it's 1.382. Is that billion? Or that's probably million shares. No, it's probably billion. I don't know what this is in. I'm looking at this table, but no, like it's been the highest number of shares. It's been, going back to December. Now at a rate of change. So I don't think people are pulling out just looking at the number of share counts, but are they actually adding in money? And, if you look at something like, you sent me a chart here, the average percent range. Yeah, I mean, it's kind of AGG after the big turn. It's still negative on a total return basis since 22 when rates went up.
Yeah, that's the average.
Slowly been coming back.
Yeah, that's the average. Monthly range. You might want to ignore that one, but it's
all right. Well, yeah, whatever.
It's trending.
I'll make it up if I don't know what it is.
Slightly trending. That's how technical analysis rolls, right? No, it's slightly trending higher though, and it seems like it's basing, but that's. You guys brought up new Fed chair, like. Could bonds catch a bid? Is there a reason why they would if the market were to pull back? Obviously not today, but, at some point for some other reason, if you started to see some panicking, do you think
there's think about in bonds, Shane? I mean, there is credit. What's the state of credit? Meaning, are there credit concerns? If there's credit concerns, meaning companies can't pay back the notes, the bonds that they've issued when they mature, or if they'll default on their interest payments, that's one type of risk. And then you look at interest rates. So interest rates have been, they're not all over the place right now. They've been in a pretty tight range for a while. And then you think, are interest rates going down? Remember, a lot of time what people forget is when the markets were going down, think about 2020, 2008, 2009, and the Fed just slams rates to, in this case, zero in 2020. Bonds get priced up because now that's just the way you price a bond. If you have a bond at a 3% coupon and rates go to zero, the value of the bond will go up because if you buy that bond, your yield to maturity is going to be zero. It's going to equal what the market rate is right now. So. No, I don't know. I think people are going into alternatives, but bonds are still a huge market, and I still think they're not necessarily selling them. I don't know if they're rushing to bonds, but there hasn't been a real interest rate component change either.
I think that makes sense. I don't know. It's just the move in oil too. Crazy, right? We saw a pretty aggressive up move. I don't know if it was up today. Yeah, it's fairly flat, nothing crazy. But, oil since about 3-4 weeks ago, we were sitting at 55 a barrel. We're back up. We topped at 66. Is there a concern that to keep things going, right? Like we turn the printers back on, we turn QE back on, and this gets hot for the sake of sort of keeping assets supported. and we see reflation. Like, I know we're not necessarily seeing it right now. There was the big bump we saw in PPI. Doesn't necessarily indicate anything at this moment yet. Those happen from time to time.
I'm going to say no, because we have over a decade of evidence. They kept rates at zero from 2009 all the way to, was it what, 2018 until they did it again? So 10 years. And we had very, very low inflation. Like, I don't think on the surface, them keeping rates low or expanding the balance sheet does anything for inflation. It's a contrarian take, I know. It is fiscal things, in my opinion, that do more to cause or hinder inflation.
So you'd argue, what are we using the money for? Like, what's it actually going to? And
when you send people trillions of dollars in funds, you send out checks to people, and both administrations did it, but you send out checks, and those people use those funds to go buy goods, and the goods all have to come from one spot, and there's a supply problem, you get inflation. It's very elementary. Mike, I wanted to ask you too, because Shane brought up oil. And look at the price of oil. Like, if you look at West Texas Intermediate, if you just chart the commodity, and then you look at Exxon. Like, Exxon's move higher on a relative basis is much higher than oil prices themselves have gone up.
Yeah, I mean, their ability, or their margins on, on the price of oil is magnified, meaning, if oil goes up 1%, that may be an increase in profit of 2% to Exxon. That could be a reason why it's run so much. It's also done nothing for a while. If I'm just looking at a 1-year chart here, I was at 108 in February of last year. Closed at, it was at 118 earlier this month. So compared to the rest of the market, it hasn't done a whole lot either.
If I look at from the end of, let's see when this is. Let me look at a 5-year chart. Oil or Exxon. All right, let me go to from the end, right around the end of December 2024. Their market cap was $472.7 billion. Today, they were at $629 billion. Like, think about that. And what that means for the weighting in the S&P. Like, Exxon was way down. We just met, like, it's been a while since I've seen Exxon that close to the top. And we know Exxon was once the largest company in the S&P 500. So that's, and this goes back to just owning the index, Mike, right? I mean, this is why you own the index, because just let the index do all this stuff, add and subtract.
Yeah, I mean, I do think it was, give you a little credit here. I think in December you asked us, is energy where you want to be next year? And
did I do it? Like a tiny amount, and in one of my personal accounts. So no, I didn't do it really, but yes, thanks, Mike.
Yeah, but you asked the question that I don't think a lot of people were thinking about, and sometimes you have to come up with a narrative of, what's the catalyst that's going to drive energy higher, and in the moment it may be hard to find one or to think of one, and that's exactly why you own the index, because it's just so hard to time these things. I mean, ExxonMobil is now up 20% year to date, maybe more. And yeah, I don't think on December 31st, anyone would have guessed that would be the case.
If I look from the year end, so let me look at Exxon and let me look at NVIDIA. And why NVIDIA? Because it's the biggest stock in the world, according to the market cap of the S&P. So I just go back and I look and I say, well, at the beginning of the year, there we go. So from December 31st, 2025 to now, NVIDIA is down 0.58%. Exxon is up 23.86%. Like, imagine last day of December, you said, I think you should short NVIDIA and buy Exxon. That's a great idea. People would be like, really? That's what you're going to do? Yeah. Apparently that's what you should have done. But you don't even need to short NVIDIA. It's basically flat. You just buy in Exxon. So, yeah, I mean, it's kind of surprising. Shane, just like we said on the annual market forecast, who knew? Buy Korea, gold, and Spain, and that would have been a heck of a portfolio to have owned in 2025.
Well, right. And I mean, I think I sent over a chart of crude and Exxon overlaid. And I mean, this is the first time really historically over the past 26 years that we've seen Exxon run like this relative to the move in oil. It's sort of the first time seeing this, at least in the 2000s. So, again, it goes back to that's why you own the index, because good luck ever calling this or timing this. I also think this goes back to,
well, apparently Mike said I did at the end of December.
Yeah, absolutely. I think you did. I mean, it's not. I don't think it's that unfeasible to come up with reasons why energy might go up, and I don't think you're wrong. But
don't you think though? I mean, I don't want to spend too much time more on this, but it's like more oil is going to be online because of Venezuela. The Guyana oil fields, which Exxon I think has a big investment in, are no longer under threat that Venezuela will come and take it over. And if the input costs are lower, you have more supply, and Exxon's profit margins are higher because their refining costs, maybe their input cost goes lower. Like, this is more than just, oil's up and so Exxon's up. This is very different. And anyway.
Yeah, because really, I mean, wouldn't you expect oil to go down just in the face of that news? There's more oil available to drill. You would expect oil to go down. So I agree. I think this is more than just Exxon's up because oil's up.
So, Mike, what's the unloved thing you should buy for the next month? Let me get my pen out, right?
I mean, we should be asking you.
I don't know. Maybe you buy, I don't know. Like, it's Mike, you buy the Mag 7 again. Maybe it's time.
The way we're talking about it, you probably should.
Yeah. Or you have to buy all of them because look at the dispersion. It's all over the place. So,
I mean,
all right.
Go.
Let's get to recommendations. And Mike, you can't recommend the people watch the Super Bowl because it probably will have already passed or will be concurrent to when this episode gets released. So you got to come up with something else.
Okay. Everyone, I hope you enjoyed the Super Bowl.
Yep.
But I'm going to go with The Studio.
What is
on
this?
Apple Plus. It is written by Seth Rogen. Seth Rogen's also in it. He is like a Hollywood studio exec, and it's it's a comedy about sort of how movies get made and the chaos that these behind the scenes people sort of encounter as they're trying to, sign movie stars and directors and just all the craziness of Hollywood. Very funny, very well made. It's a strong buy.
Oh,
yes.
Conviction list.
Yep. Highly recommend.
Okay. One season?
One season so far. Yes. They're making another one right now.
Is it all out? I don't have to wait.
It's all out. Yeah.
Okay. I'm interested then. Okay. I have a controversial take on a show. So let me go to you first, Shane. Any recommendations this week?
Okay. So, I told you I would follow up on it. We did watch it. If you're squeamish, don't do it. But the Frankenstein on Netflix, Guillermo del Toro, it was fantastic. I see why it got the Oscar nomination. It's the best rendition of the story relative to the book that I have ever seen. So it was phenomenal. If you're squirmish, go watch Groundhog Day. I think I might have mentioned this months back, but I mean, it just happened.
Squeamish, right? Squirmish?
Squeamish.
Yeah, that's right.
Yeah. Groundhog Day. Go watch it.
With Bill Murray. Okay.
Yeah, six more weeks of winter this year, he said. So
well, I realized that although that was a massive movie, like you would have been hard pressed not to have seen it either in the theaters or on any of the 8 million times that it was on HBO probably when it came out. I realized the younger generation has not seen that. So that's a good one. I like that. All right. And Frankenstein, strong buy, Shane, conviction list.
If you like those kinds of stories, yes, absolutely. It was very well done.
Okay. So it's like, it's kind of like it's kind of like a sector spider. Like if you like tech, you buy the sector spider. If you don't like tech, you don't buy it.
And you know what you're getting into, you know, you've been warned.
Okay. I actually put a sell recommendation on Landman. I know it's a little controversial here with the group. I watched it. I'm like, nothing is happening throughout. I just felt like episode after episode, nothing really happens. And I never liked, what was the show? It's Taylor Sheridan.
Yellowstone?
Yeah, I never liked that. My wife watched it. I'd go by. I'm like, nothing is happening. I never got into that show. Season 2, the characters started to grow on me. And I got to be honest with you, I came back around to it. I like season 2 a little more. So I'm taking my sell recommendation off and I'm putting a buy recommendation. Not a strong buy, not a conviction list, but it's a buy.
So did you buy to cover, or are you like buying to cover and now you're also long share?
Well, like any good trader, they can change. I can change my mind.
Of course.
So I can change my mind. I can, with new information. And, you know, I was sort of hate watching it for a while, but I stayed with it. So I kind of had the sunk cost fallacy that you're not supposed to keep watching it. You're just supposed to move on, but I did. So have you guys seen Landman?
I have not.
It's on my list. My
Paramount Plus.
Yeah, my buddy's a big fan. But my dad, I think, is watching that or plans to now. He just finished Slow Horses. That was the other one that got brought up this week on our call.
Yeah. I haven't seen that yet either. Some folks at Zega have talked about it. Yeah. So anyway, it's not a conviction list, though. It's not a strong buy, just to be clear on that. All right. I think we did it. We talked Bitcoin. We talked strategy, oil, and vol on the S&P. Like, would it surprise you guys? It wouldn't surprise me if the market sells off next week, and it wouldn't surprise me if the market just makes another run past 7,000.
That's where I'm at.
Yeah, I think that's where a lot of people are at, which means it'll do nothing next week, right? It'll just sit here.
Well, I think
it's
Shane, you mentioned it. It was unchanged, or no, Mike, you mentioned it. It was like basically it closed the week up. So if you would have not even paid attention to the market, all the gyrations in the market, just like gone and watched a game show, played golf, gone swimming. Well, live in Arizona, but maybe go watch the snowfall if you're somewhere else. I mean, this is why sometimes, like, if you watch this stuff too closely, it's going to drive you nuts and you wind up right back where you were. So, all right, that's it. We did it. Hopefully everyone enjoys the Super Bowl. I think Seahawks probably win. Do you guys feel any different? So probably the Patriots will win, right?
I think Patriots.
Okay. Shane?
My sister just moved to Seattle. She's going to get a Super Bowl, so I got to go Seahawks.
Okay. We don't have consensus, though, so that probably means maybe Seattle can win or the Patriots will win. I actually think the Patriots will win. I do want the Seahawks to win, though. Just the whole New York-Boston thing.
I don't want a high-scoring game. Keep it tight. Give me like a 10-7.
All right, we're done. See everyone. Thanks for tuning in. We'll talk to you next week.